Jackie, you may begin.
You're muted.
Sorry, I forgot that I get muted when we switch over. So good morning, everybody. I'd like to welcome you on behalf of the U.S. Commercial Service, the Connecticut, New Jersey, and New York District Export Councils. We welcome you to our Trade Talk Tuesday chat. It's part of our Global Trade Finance series. Today, we're going to be talking about managing payment risk. My name is Jackie Torsolini. I'm an international trade specialist with the U.S. Commercial Service based out of Middletown, Connecticut. We're also joined today by my colleague, Tony Sargis, who's also a senior international trade specialist located in Middletown as well. Just as a couple of items of note, today's session is being recorded. Everyone is in listen-only mode. We'll open up the microphones at the end of the session for questions and answers. During the discussion, you can answer questions into the Q&A feature and or raise your hand at the end. After the month-long program is over, so for November, we're doing the Trade Finance series. You'll be sent a survey from the U.S. Commercial Service requesting your input about the series, and any information you can provide is helpful in helping us determine what types of educational programming we can provide in the future. Also, tomorrow, Tony will be sending out a recording of this and any attached documentation. Also want to explain that the views and opinions expressed in this presentation may not reflect the official policy or position of the U.S. government. And I'd like to welcome today, we have 3 panel experts. We have Richard Foy from the Export-Import Bank. He's a regional director for the Northeast. Prior to joining the bank, Richard most recently worked in International Trade Finance Group, where he was a VP of Commercial Lending. He provided access to loans by working with various funding sources to meet the needs of his clients. Prior to this, Richard was marketing and underwriting in ocean marine cargo insurance and has an extensive logistics background with over 20 years in the field, holding positions in operations, risk management, quality assurance, and environmental affairs. We are also joined today by Joe Raycraft, SBA's Export Finance Manager for the New England region. In this role, Joe is responsible for providing trade finance expertise and technical guidance to the business and lending communities, while promoting SBA's export financing programs to exporters and lenders. Joe is based out of the SBA's Hartford office, and he brings 20 plus years of private sector business experience, including international roles in the areas of manufacturing, commercial finance, and commercial lending. Most of Joe's experience is international, with a focus on marketing, origination, underwriting, and financing of international projects. And I'd also like to welcome today Andrea Ratay with TD Bank. She has been a trade finance banker for 30 years and has worked with companies in a cross-section of industries, structuring risk management and working capital solutions for importers and exporters. Andrea has served on the New York District Export Council for over 10 years and is currently the group's chairman. Prior to banking, Andrea worked on a presidential campaign and at the U.S. Department of Commerce. She earned her undergraduate degree from Georgetown University's School of Foreign Service and has an MBA from NYU's Stern School of Business. So we'd like to thank all of our experts for joining us today. And without further ado, please, Andrea, please provide us with some great information today on how our exporters can reduce their payment risk, or non-payment risk, I should say. Thank you.
Jackie, thanks so much. And
I love being here with Joe and with Rich because it'll be, I think, a fairly inclusive conversation about payment risk across the spectrum. And Joe and Rich do bring other experience to the table as well. So this is the only slide we will be showing you today. There's a lot of information on it. So we'll give you some time to kind of drink that in. I'm not going to read the slide, but I will be focusing my remarks on this particular slide. You know, in this series that you all have been participating in, you've covered everything from marketing to supply chain issues. You talked last week about credit insurance, which really does tie into what we're talking about today as well, because we are talking about the risk of how to mitigate the risk of non-payment, because you've done all that work with identifying your customer, with arranging the freight, with getting the product out the door. Now you want to get paid. So there are two sort of purposes or benefits of trade finance, and that's broadly what I'll be talking about today. Trade finance, we look at risk management, which is the payment risk, and we also talk a bit about working capital, and believe it or not, that kind of plays into what we're talking about here. If you look at this diagram in the middle of this slide, you have the exporter and importer on opposite sides. Their interests are somewhat diametrically opposed. They are inverse, being at one end, you might sell to a buyer on open account. And Rich will talk a little bit about this in the Q&A part, where you're going to sell first and then wait for your buyer to pay. Well, I don't know if anybody's ever sold a car on Craigslist or anything like that, but think about how that works. Somebody's got to show up with cash before you hand over the title. So otherwise, you're taking the risk of not being paid. On the opposite end is the advance payment method of receiving payment for your sale. And in that case, really, you're asking your buyer to give you the cash before you pass the title over, before you sell them, before you actually give them the car. Well, that's not so comfortable either for the buyer because they are not sure they're going to get their goods. And remember, this is somewhat in the context of international, in the context of globalization, but this can also happen on a very sort of on a domestic level. So what the bank's role is really is to bring those two sides of the ladder, bring the parties in toward the middle, where there's more of a risk sharing going on. So you see a reference to documentary collections as well as commercial letters of credit. A letter of credit, I'll just hit the high points on letters of credit. First off, a letter of credit is an instrument that's issued by a commercial bank. It is irrevocable. It's on behalf of what we call an applicant. And most of the time, it is the buyer who is issuing a letter of credit through their bank, but it is irrevocable. And this is really important because it means that not only the bank that issued the LC, but also the applicant on the LC cannot unilaterally cancel a letter of credit. If you have a letter of credit, then you have every right to ship against it if you agree with the terms and conditions. It is very important to make sure you review the letter of credit to make sure that you're comfortable with the terms and conditions. And by that, I mean, what's the latest ship date? What sort of documents do you have to produce? You need to make sure as an exporter that you can access those documents. You want to control as much within the letter of credit as you can. Now, its irrevocable nature means that the buyer can't cancel it, but if you as exporter decided that the terms and conditions didn't meet your standards, you can negotiate those, or you might say that this letter of credit doesn't work for me. But usually a lot of that conversation will happen before the letter of credit is actually issued. Some of the, and typically the terms and conditions do reflect the contract that you would have already negotiated with your buyer overseas. So there is kind of a matching that goes on. When we talk about enhanced risk mitigation, I'll just quickly reference confirmation of a letter of credit. If you're selling to a market overseas and you're not comfortable with the overseas bank risk or the country risk, then you might look to have your letter of credit undertaking confirmed by a bank in the United States. And it just moves the credit risk or the payment risk one step closer to home, if you will. So we do see exporters using confirmations as an effective way to manage their risk. The cash flow side of this is if you have a buyer who's asking for extended payment terms, you might say, well, what am I going to do with that 90-day receivable that I have now? If it's under a letter of credit, there may be the possibility to discount that receivable and get your money sooner. Of course, there will be a financing cost to that, but depending on the amount, it can definitely be something that you should look into. Standby letters of credit are another type of letters of credit. There's really two kinds of letters of credit, standbys and commercial. And standby LCs are used to ensure performance as outlined under those two bullet points. And we do see in terms of trends, greater use of standby LCs in the past year and a half with for a variety of reasons. And we will probably touch on that as well in the Q&A. Very quickly, documentary collections. If you are selling to a buyer that maybe you know already, maybe you're wanting to move away from letters of credit, but you still want to control the transfer of title to the buyer, that's what documentary collections are for. And you as an exporter will send the same shipping documents that you would have used under a letter of credit and your commercial invoice and such, you will send them through the banking system. And the bank overseas, the buyer's bank will control handing over the bill of lading and the other documents to your buyer in exchange for payment or an acceptance of a maturity date, a future payment. So documentary collections are something that we see quite a lot in countries like Pakistan, India, where the central bank maybe has a ruling that the outflows for import payments must go through the banks. The documents, the transactions have to go through the banks. So then collections is also something that might be used for that reason. Typically with a documentary collection, we would recommend that if you're using that, ideally you're selling into a country where you have a couple of buyers, because if your first buyer fails for some reason or decides they don't want that shipment now, you can easily then transfer those documents to a separate buyer. It's not something that happens often, but it is something to keep in the back of your mind. It is a bit different from a letter of credit. Letters of credit are initiated by the buyer, whereas documentary collections are initiated by the seller. So with that, I'll ask if there are any questions.
So Andrea, I'll jump in with a question. You mentioned the standby letters of credit and how those are becoming. You're seeing that becoming more popular, where the overseas buyer is requesting like that advance payment guarantee. And I've got a customer that receives a large purchase order, and then the overseas buyer says, I want advance payment guarantee from you in exchange for that, let's say $100,000 payment on the contract. And then they go to their bank and they say, I need this standby letter of credit for this contract. And the bank says, great. If we'll take that $100,000 that you receive, we'll put that in a cash collateral account, and we'll issue the standby letter of credit based on that collateral. And the exporter comes and says, well, now I don't have any working capital. That's what I was counting on to help produce the goods and execute the contract. So what can a company in that situation do?
Thanks for that question, Joe. as I think I mentioned briefly, we have been seeing a greater use of standby LCs for advance payments in the past year and a half. And part of that really is driven by manufacturers who have longer lead times. Maybe they're manufacturing to specification, so they want to make sure also that the buyer has some skin in the game. So a standby letter of credit for an advance payment could be a methodology that's used. The problem that you highlight of the requirement for cash collateral can be solved potentially in two ways. Depending, $100,000 is not a little bit of money, right? It's a lot of money. So if a company is looking at a situation where they're getting contracts that are valued at $1 million, I would venture to say that the first conversation they want to have is with their bank about actually structuring a line of credit to support letters of credit. A line of credit, a credit facility could be set up where cash collateral is not required. Having said that, as we probably know, in the small business segment, under lines of 350,000 or 500,000, the cash collateral requirement does often come up, unfortunately. Another solution is to think about or to look at, if you are really intent on exporting, or maybe you have this one big purchase order that you need to have financed, is to look at the export working capital programs that are offered both by SBA and by EXIM Bank. And the advantage there, we don't have time to go into those programs so much, but it's the US government programs to help promote US exporters. A key advantage with both of those programs is that standby letters of credit issued under the SBA or EXIM export working capital programs are collateralized only at 25%. So if you have a $100,000 standby letter of credit need, it would, in a conventional setting, be booked at $100,000 of the line of credit. But under these working capital guarantee programs, it'll be booked at only 25,000 instead of 100,000. So there's a real advantage there, and I would encourage anyone who's looking at, multiple export contracts or just that really one big one, talk to your bank and have them put you in touch with their EXIM expert or their SBA expert to talk about some of these cash flow solutions.
Thanks, Andrea. That was a good response. The other thing, just looking at the payment risk ladder, I know this isn't a foreign exchange discussion, but I do have companies, when I'm talking to them, ask me, should I consider accepting foreign exchange when I'm selling to overseas buyers? And I'm curious to understand your advice in that situation.
Thanks, Joe. The need for foreign currency or to sell in foreign currency is something that U.S. companies don't typically. We have the enviable position of living in the country that has the strongest currency around the world, right? So that means, and it's also a safe haven very often. So that means actually that dollars are, much of trade is denominated in dollars. Even if you look, we were talking earlier about oil prices, those are in dollars. So is it important? Looking at an individual transaction, something to keep in mind is who is your competition, because your competition might not always be a US company. It could be a company in another country who maybe is selling, maybe it's a German company who's selling to an Italian company, and so they're selling in euros. And so the buyer may prefer that. So it depends on the competitive situation that you find yourself in. But I would also say, if foreign currency comes up as potentially giving you a competitive advantage, don't walk away from that possibility, because not only the banks, but also foreign exchange houses have the capacity, have the capability to help you talk through how to hedge that risk, how to manage that risk of receiving foreign currency as payment for your goods.
Yeah, exactly, because the hedging from this side might be more inexpensive than a company, let's say in Mexico or Turkey, that has to hedge their local currency. The cost might be higher on their side.
That's a
So,
great point, Joe. Yes, absolutely.
This is another question I get a lot, and I think it might be more appropriate for Rich. Company is a small business, and they say, I really think that I could generate more sales if I provided my overseas customers with open account terms. Of course, they're fighting with their internal finance people that don't, they're very happy with advanced payment terms. But the international salesperson that's managing that really sees an opportunity to increase sales, make a closer relationship with the business, and wants to, push for open account sales. So in that situation, the company, is concerned that if they do offer open account terms, that they're not going to get paid, or they're going to get paid slow. And so is there anything that a company can do to kind of help mitigate that payment risk if they do, extend open account terms to overseas buyers?
Sure. Yeah, we get this, quite frequently where folks are seeing opportunity, but that opportunity comes with a certain amount of risk. As Andrea stated earlier, open account does pose risk. So what EXIM Bank does is we offer export credit insurance directly on those foreign receivables. So that provides you kind of a safeguard against non-payment, because the way it's structured on a multi-buyer policy, for example, is we'll insure and cover 95% of that open invoice. So if your buyer fails to pay you after, of course, we've approved the limit and so on, then we would pay you. There's a small waiting period. You file the claim, give us the documents, and we settle the claim with you, and then work out that receivable with the foreign buyer. And you're right. Requiring advance payment can be very limiting. Early on, people are also fearful or overwhelmed by the banking products that Andrea offers. Letters of credit can be intimidating for new, folks that are new to international, and it can scare a lot of people away from really good opportunities. So we try to make things as seamless as possible. We don't add any additional burdens to your documentation, and it's a pretty seamless structure. So I'll be happy to talk to anyone who has questions about it.
So just a follow-up question on that. If a company has, let's say, a half a dozen or a dozen distributors around the world that they're selling to, and most of them are on an advance payment, or maybe they do a combination of advance payment, a little bit of open account terms, and they come and they say, I really want to do open account terms for these 6 or 12 distributors that I have. What kind of due diligence would they have to do? And because that company isn't going to know the credit quality of its distributors in Southeast Asia or Eastern Europe. So how is the due diligence done? Is that done by EXIM Bank, or does the company have to kind of do some of that legwork?
Well, both. I'll say we have an express multi-buyer policy, and what that does is for a slightly higher rate, we do all of the credit work for the exporters. So you give us basically the name of the foreign buyers, some key information about your relationship and history. We do all of the underwriting and sleuthing from a credit standpoint. Also, you can rely on a broker to do some of that work for you. If you don't, and all of our brokers, we accept our applications through our broker network, and they all have the ability and knowledge of the programs to put together a good credit package for our underwriters. So you can have a little bit more freedom and a lower rate and take that work on yourself as an exporter, or you could defer it to us on our kind of new to exporting on open credit type policy, which is the Express.
Could I just add to that? I would say also, to sort of tie in the credit insurance and the working capital side, if you do find that you have multiple buyers overseas and you're looking at the credit insurance, One advantage is that for your line of credit, banks typically, they won't look at foreign AR, accounts receivable, as collateral for lines of credit. But if those foreign AR are insured, whether it's EXIM Bank or a private underwriter, that can also enhance or bolster your liquidity, your access to working capital if you have credit insurance. So we like to sort of look at these instruments, the credit insurance, the letters of credit, based on frequency of shipments, size, different solutions for different types of transactions sometimes, but it's all within that broader ecosystem of how do you get more working capital?
Yeah, I'm glad you brought that up, Andrea, because it is an important point. And both Joe's program with the SBA and EXIM, they work very similarly in terms of how we support accounts receivable, foreign AR. We allow lenders to advance 90% of those invoices, where typically they won't look at them if they're uninsured. So what happens here is, once you start exporting on open payment terms, your buyers, now they have a float, so they're going to order more. So you're going to, as an exporter, need more working capital to deploy. And this is why these two programs work so well together, because as your AR grows, your borrowing base also grows, and then you can put that money to work on those new orders. So thanks a lot for bringing that up, Andrea.
Great,
Jackie,
thank you so much. Yeah, so we're at 11:27. I'm just going to put a